name is Yasaman and I'm an economist at the Reserve Bank of Australia. This video provides a brief summary of current economic conditions as published in our August statement on monetary policy. Let's start by looking at the global economy. Inflation has been at multi-decade highs in most economies over recent months and well above many central banks' inflation targets. Inflation has also been broad-based and more persistent than anticipated. We can see in this graph that headline inflation on a monthly basis has been consistently higher than core inflation of late, as food and energy prices have risen, reflecting major disruptions to global supply due to Russia's invasion of Ukraine. And core or underlying inflation, which excludes more volatile energy and food prices, remains elevated in many economies and is yet to show signs of easing. This graph shows that high core inflation now reflects rising services inflation, offsetting a gradual moderation in goods inflation in some economies. Inflation for many types of services has increased in most economies amid a recovery in the demand for services, faster wages growth, and increasing prices for commodities used as inputs, such as food and fuel. What households and businesses expect inflation to do in the future plays an important role in determining the rate of inflation. This is because inflation expectations can affect households and businesses' wage negotiations and price-setting behaviour, which can influence actual inflation outcomes. In this graph, we can see that households' inflation expectations for the year ahead have increased sharply in response to recent high inflation outcomes and are now at their highest level since the early 1980s. Households' expectations for inflation in the medium term have also increased, but they remain much lower than short-term expectations. This indicates that households expect inflation to moderate substantially to ranges broadly consistent with central bank targets. Other measures of inflation expectations, such as from financial markets, show a similar trend across a number of economies. Central banks in most economies have increased their policy rates in recent months to address high inflation and the risk of this becoming entrenched in longer-term inflation expectations. The increases in policy rates have been relatively rapid compared with the past for many advanced economies' central banks. Central banks in most advanced economies have signalled that further policy rate increases are likely to be needed in the near term to return inflation to target levels. Looking at this graph, financial market participants expect policy rates will peak earlier than as at the May Statement of Monetary Policy update. While wages growth has picked up in many economies alongside very low unemployment rates, wages have not kept up with inflation and have declined in real terms. This reduction in household purchasing power, in combination with tighter monetary policy, means that global economic growth is now expected to be markedly lower over coming years. Now let's turn to the domestic economy. The Australian economy was resilient to the disruptions caused by the Omicron outbreak of COVID-19 and the East Coast floods in early 2022. The strength in the economy has been particularly evident in the labour market, where the unemployment rate has declined to 3.5% in June, its lowest level in nearly 50 years, seen in the blue line. This decline in the unemployment rate reflects strong demand for workers. Firms have not only hired new staff, but also increased the hours worked by existing staff, with many part-time employees shifting into full-time work. This has helped push the underemployment rate, the purple line, down to very low levels in recent months. This fall in both unemployment and underemployment has seen overall underutilisation, the sum of the blue and purple lines, decline to its lowest levels since 1982. The number of job vacancies that firms are trying to fill, a useful indicator of labour demand, are at historically high levels across most industries. Looking at the blue vacancies to unemployment line in this graph, we can see that there are actually nearly as many job vacancies as there are people actively looking for work. Many firms are also reporting that finding suitable labour is a severe constraint on their output. These indicators suggest that we will see further strong growth in employment over the rest of the year. The supply of labour has also increased in response to the strong demand for labour. That is, more people are choosing to enter the labour force. The participation rate, which is the share of the population aged 15 and over who are employed or actively looking for work, increased to a record high of 66.8% in June. The unemployment rate is forecast to decline a little further to around 3.25% in late 2022, before rising modestly thereafter as growth in domestic activity is expected to slow. Consistent with the continued tightness of the labour market, economic growth is also strong. This graph shows that the Australian economy grew by 0.8% in the March quarter. Public spending, shown by the red bar, was particularly strong, reflecting pandemic and flood-related spending. This included the deployment of defence personnel to assist flood-affected communities throughout Queensland and New South Wales. Net trade subtracted from growth in the March quarter. Exports declined due to production disruptions in the resources sector, while imports grew strongly as firms filled order backlogs and rebuilt inventories. The top panel of this graph shows the level of nominal household consumption and household disposable income. The share of disposable income which households don't consume each quarter, known as the savings ratio, is shown in the bottom panel. The lines to the left of the vertical line are actual outcomes, and the lines to the right are forecasts. Consumption led the increase in economic growth in the March quarter, as spending on discretionary goods and services, including travel and hospitality, continued to recover from prior COVID restrictions and the full reopening of the international border. The resilience in consumption partially reflects strong growth in disposable income, which continues to be supported by strong labour market conditions. Higher consumption saw the savings ratio decline in the March quarter, but it still remains higher than before the pandemic. The domestic economy is expected to grow strongly over 2022, as household consumption is supported by strong labour income growth and education and travel services exports pick up. However, headwinds are strengthening and GDP growth is expected to slow in 2023 and 2024. Households' budgets have come under increasing pressure from rising prices, particularly for food and energy, and higher interest rates. Consumer sentiment has deteriorated sharply since the start of the year, and housing prices have begun to decline alongside weaker activity in the established housing market, rising interest rates, and the expectation of further increases in the cash rate. Wages growth has picked up as the labour market has continued to tighten. The Wage Price Index, or WPI, grew by 2.4% over the year. While this is higher than during the height of the pandemic, overall wages growth currently remains around the low rates observed in the years before the pandemic. More timely information from the bank's Business Liaison Program and other business surveys suggests that wages growth has increased and will pick up further in the year ahead, alongside continued tightness in the labour market. Growth in the WPI is forecast to pick up to around 3.5% by mid-2023 and 3.75% by end 2024. This would be the highest level of wages growth since 2012. As is the case overseas, inflation in Australia is high. The headline Consumer Price Index increased by 1.8% in the June quarter and by 6.1% over the year. The last time year-ended CPI inflation was this high was the early 1990s, before the RBA had adopted its inflation target of 2 to 3%. This outcome was higher than anticipated a few months ago, largely reflecting increases in fuel, fruit, and vegetable prices. This graph shows the contributions to the quarterly growth in consumer prices. You can see that the prices for newly constructed dwellings, which make up just under a little under 10% of the CPI basket, and is shown in blue, accounted for around 1/3 of the increase in the headline inflation in the June quarter. This primarily reflected further substantial increases in prices charged by builders in all capital cities amid sustained strong demand for housing construction. Consumer durables inflation, shown in red, continued to increase strongly over the June quarter, reflecting global supply chain disruptions, sustained global and domestic demand, and high transport costs. Grocery prices, shown in orange, rose further over the June quarter as supermarkets continued to pass through cost increases from suppliers. Grocery suppliers have faced widespread cost increases, including for things like fertilizers, chemicals, shipping, and packaging. Adverse weather conditions, which affected the supply of certain items, also helped to push the prices of fruit and vegetables higher. Alongside high headline inflation, measures of underlying inflation were also very strong in the June quarter, reflecting broad-based price increases, with around 3/4 of the CPI basket recording annualized price rises above 3%. Trimmed mean inflation, shown by the blue line, was 4.9% over the year and 1.5% in the quarter, the strongest outcome in year-ended terms since 1991. Headline and trimmed mean inflation are expected to increase further in the second half of the year, peaking at around 7.75% and 6% in year-ended terms in late 2022, respectively. From early 2023, inflation is expected to moderate as global supply-side problems continue to ease and commodity prices stabilise. Further increases in labour costs in response to the tight labour market are expected to become the primary driver of inflation outcomes later in the forecast period. By late 2024, inflation is expected to decline to around the top of the 2 to 3% inflation target range. Short-term inflation expectations increased further over the June quarter, but most medium and longer-term inflation expectations remain anchored and consistent with the RBA's inflation target. This suggests that the current period of high inflation is expected to be relatively short-lived. With inflation rates well above wages growth, real wages continue to decline in the March quarter and are expected to decline further over the next year. As we have seen, inflation in Australia is the highest it's ever been since the early 1990s. The Australian economy is expected to continue to grow strongly this year, and the labour market remains tighter than it has been for many years. The board has stated that it places a high priority on the return of inflation to the 2 to 3% target range over time, while seeking to do this in a way that keeps the economy on an even keel. Accordingly, the board followed up the initial increase in the cash rate target of 1/4 percentage point in May with 3 increases of 0.5 percentage point in each of the following 3 months, taking the cash rate target to 1.85%. This increase towards more normal levels is required to bring inflation back to target and to create a more sustainable balance of demand and supply in the Australian economy. The board expects to take further steps in the process of normalising monetary conditions over the months ahead, but it is not on a preset path given uncertainties around the economic outlook. The size and timing of future interest rate increases will be guided by the incoming data and the board's assessment of the outlook for inflation and the labour market. And that wraps up our August Statement of Monetary Policy. The link to the statement can be found below. Thank you for watching this update, and please feel free to explore our website for more information, including some video explainers about key economic issues.